You must have heard of SIP. But are you confused about what it really means and how do you start it? Here's a quick snapshot to help you jumpstart your SIP journey. What is an SIP? A systematic investment plan, or SIP, is a smart and hassle-free tool for investing in mutual funds. It is similar to a recurring deposit where you save a fixed amount regularly for a period of time. The difference is that with SIP, you invest a fixed amount regularly in mutual fund schemes. These schemes have the potential to beat inflation and create wealth for you in the long run. Why invest through SIP? Power of compounding. An SIP, which continues for a longer period, helps you to harness the power of compounding. Small amounts invested keep adding up to create a large amount of money. Do you know that by just investing rupees 5,000 per month from the age of 25, you can create a wealth of approximately 3.2 crore rupees by the time you retire? That's the power of compounding. You can start small. You don't need to wait till you have a large amount to invest. Through SIPs, you can start with an amount as small as 500 rupees a month. You get flexibility. SIP gives you the flexibility to choose the amount you want to invest, the frequency of investing, the scheme you want to invest in, and the time you want the SIP to continue. You can invest either daily, monthly, or quarterly in the scheme of your choice based on your preference. No need to time the market. With SIP, you invest regularly in mutual fund schemes, irrespective of market ups and downs. As a result, the cost of purchase is averaged out over a period of time, and you don't need to worry about timing the market. It is very convenient. Investing through SIP is very convenient. The amount you choose is auto-debited from your bank account at the pre-decided frequency. So you do not need to worry about how to invest every month, which in turn helps you instill financial discipline. Thus, SIP helps investors get the benefit of compounding and can build wealth in the long term. How to start an SIP? To start an SIP, you first need to get your KYC done. You can either speak to a financial advisor, walk into an investor service center, contact registrar and transfer agents like CAMS or Karvy, or visit any of the online platforms. You need the following documents with you: ID proof, address proof, one passport size photograph, and a cancelled check. This gets you mutual fund ready. Then you can select a scheme that suits your investment objectives and risk profile. After this, you just need to decide on the amount, frequency, and time period of investment. Finally, you start your SIP, wherein a fixed amount, as decided by you, is invested in the fund of your choice from your bank account. And yes, you can also stop the SIP anytime you want. There are no penalty or charges to stop. In the long run, SIP investments can help you fulfill the big dreams of your life by starting small with SIP. Start investing today. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Power of compounding. Have you ever wondered how a small initiative of yours can create a multiplier effect in your life? Let me take you to the world of Mr. Sagar. While returning home one day, Mr. Sagar came across some mango tree saplings being sold at the market. So he bought one, thinking it would be nice to have a mango tree in his backyard. The next morning, Mr. Sagar planted the mango sapling in his backyard, not aware of the magical consequences of his actions. He watered the soil around it, full of hope that the plant would start to grow and bear fruits very soon. Weeks and months passed by. In the meantime, Mr. Sagar would nurture the plant on a regular basis, water them, prune unwanted twigs, and use good quality fertilizers. Slowly, the plant started growing into a tree. But even after 3 years, the mango tree did not bear any fruit or flower. On top of this, after 5 years, there was a huge storm one day, and due to such bad weather, the tree became very weak, shedding a lot of its leaves. But keeping his faith on, he kept nurturing the tree and the tree kept growing bigger. 7 years later, one day he noticed that the tree had started bearing some flowers. Slowly, those flowers turned into fruits. At the end of 10 years, the tree was fully grown, bearing a lot of fruits and flowers. A happy Mr. Sagar, along with his family, shared this bounty with their relatives and friends. Hence, Mr. Sagar's patience finally paid off. Investments also work in a similar manner, where patience is the key. Do not get disheartened or panic if you do not get the expected returns from your investments in short or medium term, that is 3 to 5 years. Be patient and you would start reaping the benefits through the power of compounding, which can help your investment grow into a substantially bigger corpus in the long term. Start investing in mutual fund schemes today. Reach out to your financial advisor to know more. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Behavioral biases are preconceived notions or prejudices that often lead investors to make emotional and irrational decisions when it comes to investing. Let us understand how behavioral biases can get in the way of sound financial decisions. Meet Arjun, who is 35 years old and wants to make smart investment decisions. He is a strong supporter of the equity market and decides to invest some money in equity mutual funds. He scans through a few newspapers to find out the most popular equity funds in the market and invests in one of them. This is attention bias. In this bias, investors tend to invest in financial products which are frequently highlighted, say in newspapers, news channels, without analyzing their suitability any further. The next day, Arjun meets his colleagues Naveen and Vinita over a coffee break. They start discussing on various investment options to build a retirement corpus. Naveen puts forward his belief of investing in safer avenues like debt funds and fixed deposits. Arjun, however, emphasizes on the potential of superior returns of the equity market. Vinita, being a strong supporter of safer investments herself, ignores Arjun's opinions and focuses only on what Naveen says. Here, Vinita exhibits confirmation bias. In this bias, investors tend to seek out only those information or opinions that support their preconceived notions about investments. They tend to turn a blind eye towards information that does not support their opinions. Undeterred by the conversation, Arjun decides to invest some money in another equity fund. He does a quick scan of the last quarter returns for the mid-cap equity funds and invests in a fund which has performed spectacularly in the last quarter. Here comes our next bias, recency bias. In this bias, investors tend to invest in instruments which have only performed well in the recent past, without considering their long-term performances or other factors. Naveen, unlike Arjun and Vinita, is in his 40s. He is confident in his ability to build a substantial retirement corpus, even if he starts investing when he's closer to his retirement. He is very optimistic that he would be able to build an adequate corpus to lead a comfortable retirement life. Now,
Okay. Hello, good evening, and a warm welcome on behalf of HDFC Mutual Fund. My name is Sresh Sahani, and I look after the Eastern Zone for the firm. It is indeed a great pleasure to connect with all of you, along with our entire team, and would like to thank each one of you for joining this webinar today. I sincerely believe that all of you and your family members are safe and fine. Request you to please take utmost care of yourself. For today's webinar, we have Shobhit Mehrotra, our senior fixed income fund manager and head of credit, with us today to share his views on debt market and our funds. Friends, Shobhit has over 25 years of experience in investment industry, and he manages HDFC Credit Risk Debt Fund, HDFC Medium Term Debt Fund, and few of our other open-ended and closed-ended schemes. With that brief introduction, I would now like to hand over the call to Shobhit. Shobhit, over to you.
Thank you, Shrestha, and thank you everyone for joining in this afternoon to hear views on debt market. Actually, the message from debt market is quite simple. Whatever has been happening over the last several weeks, one thing has come out very clearly, and that is that RBI is quite determined to not allow yields to go higher. If you see all major measures or announcements from RBI, they have been quite emphatic about sending out a message that RBI would not allow yields to go higher. It all actually started from the last Monetary Policy Committee meeting on 9th October, when 3 new members joined in the MPC. The guidance which this MPC gave was quite strong. They said that the accommodative stance of RBI will continue not only in this fiscal, but will also continue into the next fiscal year, which means that until at least first or second quarter of next financial year, FY22, RBI will remain on accommodative mode and will ensure that rates remain soft, liquidity remains ample in surplus, and yields do not rise. So this is a big positive for the bond market, because a lot of debt market players were concerned in this year because fiscal deficit for the current year, instead of 3.5 is likely to go to over 7 or even higher than 7. Combined deficit of state and center is likely to exceed 12%. So with this kind of a combined fiscal deficit, there was going to be a huge supply of government bonds in the market. And naturally, the market was worried that this kind of a large supply may not get easily absorbed, and therefore yields could rise. Now, RBI has clearly mentioned that their OMOs will continue. They have increased the size of OMOs from 10,000 crores to 20,000 crores. They have also announced for the first time OMOs on state development loans, which earlier RBI never used to conduct. Along with this, they have also announced 1 lakh crores of on-tap TLTROs for the banking system to give credit to some sectors which have been affected because of COVID. So with all these measures, liquidity is likely to remain very good, and the large government borrowing program of now in excess of 13 lakh crores of government borrowing program will go through without much of an impact because of continuous support which is coming through from RBI. The second important aspect has been in terms of their comments on inflation. As you all would have seen, recently inflation has been rising. It has been above RBI's comfort zone. In fact, on 12th November, the data for October month is again likely to be above 7%. So, market was quite worried that this spike in inflation can be considered a big negative, and yields therefore were not coming down. Now, RBI has said that this spike in inflation is majorly due to supply side issues, supply side disruption. It is because of food items, vegetable prices which have gone up. It is basically onion, tomatoes, and potatoes, all these vegetable prices which have really gone high. So all these factors are temporary in nature, transient in nature, and RBI feels that by the end of this year, inflation will start coming down. By Jan to March, the expectation is it should be between 4 to 4.5%. And if inflation comes down as per RBI's expectations, then RBI has said that there will be space for future rate cuts, which is again a big positive. And market expects inflation to start coming off, not in the latest reading, but from November, December month, inflation readings will be far better. So the focus of monetary policy, the focus of RBI now has clearly shifted towards reviving growth. We all know that this year the GDP is going to contract by 9.5 to 10%. There is a huge potential output gap, and as long as this gap is there, I think RBI can at least ignore for some time the temporary rise in inflation and focus more on reviving growth. So in this market, we feel yields will not rise, but it may also be difficult for yields to come down in a big way. Already some softening or some correction in yields, and yields have come down from the highs of 6.5% on the 10-year, which we saw. We are already down to 590 or close to that. So the room on the downside we feel is around 10-year bond could go down to 575. On the higher side, we think 610 is where RBI gets uncomfortable. As soon as 10-year bond yield goes above 6% mark, we have seen RBI come into the market and either start buying GSEC or does some supportive measure which cools down the market yields. So the message is basically simple, that yields will have a softening bias because of the liquidity pressure, which is because of the excess liquidity in the system, which RBI is allowing the system to have, and it will be trading in a narrow range. On the lower side, maybe 10-year may go towards 575. On the upper side, we think 610 at best. So that will be the range for the 10-year. Now, moving on to credit markets, we've seen a lot of action. You all would have seen post April, May, once some of the schemes of Franklin were wound up. There was a lot of turmoil in the market, but all that is now history. The liquidity in the credit market has improved significantly. There is more and more trading of AA bonds. Non-AAA companies are able to access the bond market. They're able to raise money. Non-AAA AA assets are in good demand. A number of people were worried that once the moratorium period gets over, we will see the banking sector come under stress. We will see NBFCs come under stress. The NPAs will shoot up. But nothing of that sort is really playing out. Whatever results we have seen till now, whether they are of NBFCs or banks, the results have been very good. The data which we are getting from NBFCs is quite positive. We are seeing month-on-month collections improving. If in the month of April and May this year, collections had gone down to 40-50%, from 40-50%, we have bounced back up to over 80%. So things are definitely on the improvement side. It is showing a very good trend of collections improving, liquidity coming back, NBFCs finding liquidity from the banking sector. And in this environment, we feel that the spreads which are available on AA assets still offer great value. AAA corporate bond spreads are quite low. They have already reached their near their historic low levels, but AA spreads are still quite attractive. So what we feel is there is value in looking at funds which have exposure to non-AAA assets, and two funds stand out. The first one is HDFC Medium Term Debt Fund, and the second is the Credit Fund. In both these funds, the portfolio yields are still quite high. If you compare their portfolio yield of medium term and credit funds portfolio yield with AAA corporate bond fund portfolio yield, the gap is still quite large. Corporate bond funds, the portfolio yield on 100% AAA portfolios is down to 530, 540 today, while medium term is still above 7%. We will be perhaps closer to 715 to 725 on medium term. On credit fund, we are still close to 9, around 890 to 9 band. So this gap of 540 versus 7 and 9 is where we feel there is still a decent spread for an investor to consider investing in these two category of funds. The composition which we have on the medium term is basically 60 to 65% is AAA or GSEC, and 30 to 35% is around AA category in the medium. hardly 1.5 or 2%, less than 2% is a single A, only one security on the portfolio. So this is where we feel, there is a good pickup of yield which an investor can benefit from in the medium term category. In the credit fund, traditionally we have been running the fund with large component of AAA. Even today, we would be above 35% of the portfolio on AAA allocation. AA assets would be 40 to 45%, and remaining would be single A. So with this kind of a composition with good amount of liquid component of AAA assets, we feel both medium term and credit offer a good opportunity to investors to look at from next 1 to 3 year perspective. Other than that, my suggestion to investors would be to consider 3 buckets of our debt funds. One would be your extreme short bucket, in which one can look at ultra short, floating rate fund, money market, or low duration. That becomes your one bucket of around 1 to 1.5, 2 year or less than 2 year average maturity products. The second bucket is of short to medium term category, which would comprise short term debt fund, corporate bond fund, and banking PSU. So if within this is all largely focused on AAA, largely high quality, 3-4 years average maturity funds. This would be the second bucket. And the third bucket is of credit-oriented products, which will be medium term and credit. I think if one looks at these 3 buckets from an investment perspective and allocates whatever allocation one can do based on their individual's risk appetite, I think the task becomes quite simple. Our own recommendation would be to look at least 10 to 30% allocation in credit to medium term. I think that can improve the overall portfolio return for an investor. So with these words, I think I will stop here, and maybe we can now open for questions or comments or queries or any other clarification which anyone needs.
Sure. Thanks, Shobhit, for that quick update. So we have already received a few pre-submitted questions from our distribution partners. So would request if we can take them. So first thing, Shobhit, during the last conference call, we spoke about US elections as immediate event to watch about. Now US election is over. Do you see any immediate global risk having significant impact on Indian debt markets?
So I think the direct impact on debt market, to my mind, is very little. The only way we get impacted is through FII flows or through whatever those flows have impact on the currency or the rupee. And as most people are expecting, with now it being clear that the decision has gone in favor of Democrats, the global markets are going into what we call the risk on mode, which means there will be more liquidity which will come into the markets. The expectation is that the new government in the US will approve a $1 trillion stimulus package, which will provide additional liquidity, which means flows into emerging markets will be quite good. The expectation is that both equity and debt should see more and more of foreign institutional investors' money coming in, which will be quite positive for both for bond market and equity markets. And I don't see the development which is taking place in the markets today, getting any negative hit because of the global change.
Sure. Next question is, Shobit, do you see any risk of default or stress in near term? This is primarily due to COVID-19 in any of our papers or holdings in both our funds, credit risk and the medium term.
So absolutely not. I think we have been closely monitoring all the portfolio companies. We've been talking to managements, and we are seeing a very significant improvement in the refinancing capacity of the companies. As I mentioned earlier, collections which had dropped to 40-50% have bounced back to 80-90%. So collections for companies have improved. The liquidity situation has improved. Banking system liquidity is very good. Working capital funding is being made available to a lot of companies. So I am not seeing any signs of stress where we would be considering a stressful situation for our companies. There has been only one company where there has been a downgrade of a rating. We are actively discussing with them for a buyback or an early payment. Within the next 2 or 3 months, we will be, in fact, completely out of that holding. And we are quite confident that we will get an early repayment even much before the maturity on this paper. So whatever portfolio holdings we have, I am not seeing any holding where there is any concern of even a delay of 1 day of interest or any such thing. Touch wood, we are sitting on most names which are doing fine and well.
Sure. Next question is, Shobit, we have partners holding a lot of money in liquid, ultra and low duration fund. Given the drop in YTMs of these schemes, and if the money of 1 or 2 year horizon is available, do you suggest to take 20-30% allocations in medium term fund or the credit risk fund?
Yes, absolutely. As I said, these 3 buckets one has to keep in mind. You talked about a lot of people having money in ultra short, low duration, money market, floater, liquid. So basically, all this is liquid or liquid plus kind of money. I would not put more than 10% of my allocation or 15% of my allocation in such a bucket. I think the balance has to be allocated either in short-term debt, corporate bond, banking PSU. That is your second bucket. And the third one is your credit and medium. So I would not hesitate to go up to 30% on, credit or medium term. 30 and 10 makes it 40, and maybe 60% goes to high quality, which is your corporate bond or banking PSU or short-term debt. So, very broad allocation of this kind can be looked at. Of course, it will all depend on, individuals' risk capacity and their existing allocation, which is already there, and, where would you want to take it to?
Sure. Next question, Shobit, is with economy unlocking, do you see credit offtake picking up in next 2 to 3 quarters? If yes, which schemes get most benefited out of it?
I don't really see credit picking up in a big way. Credit offtake has been very slow in the economy because with the unlock, what is happening is just normal businesses, resuming or coming back. Credit offtake becomes good only when investments start taking place in the economy. Okay, whenever there is a capex cycle, new projects being put in, or brownfield projects, greenfield projects, and new capacity being added, that is when really credit demand picks up in a big way. But that is still quite far away. There is still, I think, maybe 18 months, 24 months before we can see any signs of investments picking up. I think right now, as most of the capacity is still underutilized, so there's no need for new capacity addition, and therefore, investment cycle will take a long time before it picks up, and then, thereafter only demand will pick up.
Sure. Next question, Shobit, is this is more, a lot of investors have invested into bank FDs in last few months and few quarters. So the question is, how much a person can still expect from PSU banking debt fund over FDs in next 2 to 3 years, given tax efficiency over FDs?
So say broadly, I think banking PSU is already around 575 on the portfolio yield already, even just as in fixed deposits of banks, rates have come down. So have we seen the yields on portfolios coming down, right? Banking PSU, I think, used to be much higher. I think there the yields are already at 575. So 575 minus expense is what broadly one can look at as your, earning, maybe some capital gains. But broadly, I think to keep a conservative estimate, one would have to just consider the top line as 575 minus your expense. That would be your net return plus all the tax gains which one would get. So I think typically today, 1 year FD on a bank is hardly, maybe 5% or sub 5. So, in that from that point of view, these products are still good. Additionally, they give you the flexibility, so one can, part, withdraw, or continue for, instead of, even if you have entered with a 1 year view and you can continue for 3 years, your indexation advantage goes up even more. So those kind of flexibilities, I think, will definitely be there in the mutual fund. And I think all our products, whether it is short-term debt, medium, or banking PSU, all of them offer that flexibility that in case the money stays there for 3 years or 5 years, the indexation advantage just keeps growing.
Sure. Next one is, Shobit, do you still see spread compression happening across the band, that is in AAA, AA, and single A category bonds?
I think spread compression has already started in the non-AAA space. We've already seen some spread compression happening. AAA spreads, we don't see much of a scope for compression. I think AAA spreads are already at quite a low levels. Non-AAA space also, some spread compression has happened, but that has happened in select names and select sectors. But still, there are number of credits, number of companies where AA bond spreads are still quite good. I think over the course of next 1 year, I think some of those names will see big spread compression happening. Certain credits people are still without much of a cause for concern, or people are still worried, and because of that, yields on those credits are still high, and that is where the second stage of spread compression can happen in the course of next 1 year. So yes, I think AA's we will see far more compression, but I think over the course of next 1 year.
Sure. The next question, Shobit, is on AT1 bonds. So what's the status on AT1 bonds specifically? PSU banks which you are holding, has any yield compression happened there?
Yes, yield compression on PSUs has also happened quite a lot. In fact, the reason why banking PSU fund yield has come down is because of this spread compression. And again, the view on the kind of perpetual AT1s we hold, we are quite positive. The names which we have are either very strong private sector banks or government-owned banks, and what we are seeing is that the sovereign support, sovereign support for these securities or sovereign support for perpetual bank bonds has been, throughout there, and we don't consider this government support not coming in. And there is already a talk and plan about recapitalization happening in FY22. So government is already looking at adding equity or recapitalizing these banks in the next year. And I think the worries which some people earlier had on some of the banks showing large losses, and there could be a delay in coupon on the AT1s. I think all that is absolutely unlikely to play out, because firstly, I think the banks have shown a very good recovery from the large corporate NPA cycle, the cleanup which has already happened. And going forward, the moratorium related whatever NPAs will be generated will be spread out over the next 2 years. And always we've seen that the retail, SME, and those kind of assets do not give you a one-time shock to the banking system. I think those whenever the retail segment NPAs are created, they are far more manageable. They happen at a slower pace and gives banks more time. And RBI has allowed 2 years for restructuring, and we feel that that period is good enough to manage the entire situation.
Sure. Thanks for the update, Shobhit. Next one is Vedanta Limited is among the top holdings in both our portfolios. So your views on Vedanta and your views on Simplex Infrastructure also.
Yeah. So Vedanta, I think the good thing is that the company's business and cash flows have improved in the current year. So we've seen that commodity prices from the bottom, which they were 6 months back, have already started to come up. They have bounced back. So the operating cash flow or EBITDA of Vedanta, which last year was say 20 to 21,000 crores, this year is likely to be 24,000 crores. Next year, this number will in fact go up to as high as 30,000 crores. So as against this kind of operating cash flows, the net debt to EBITDA number current year in FY21 is likely to be 3.2 times, and next year is 2.8x. So net debt to EBITDA, Vedanta looks better than other metal companies. It is a better net debt to EBITDA than even Hindalco. It has a better net debt to EBITDA than JSW or Tata Steel. So fundamentally, there is absolutely, in terms of cash flows, availability and servicing of bonds is concerned, I don't see any issue that Vedanta will not be able to service. The only issue lies at the holding company level, at the holdco level, where the parent of Vedanta Limited, they have some debt, and what is happening is the cash flows or the dividend which the company is getting is being upstreamed to service the debt of the parent, which is going to delay the deleveraging at the operating company level. So I think the challenge is only for this current year, and I think through intercorporate loans, the operating entity has, for the time being, taken care of all the debt repayments at the parent level which are falling due, have all been taken care of. So we now think that absolutely no issues for them to not be able to refinance their debt and have any difficulty in servicing the debt. As far as Simplex is concerned, I think Simplex is already, all the creditors, including all the banks, are discussing a resolution plan. It is in the final stages. Once the resolution plan is approved and implemented, we do see, there is a possibility that the company can revive and, will be slowly able to start servicing their debt, I think, after a moratorium period of some time. So here also, as far as our exposure is concerned, we have an exclusive security. So it is not as if that we have a security which we are sharing with all other creditors. We have an exclusive security which is available to us, and we have already marked it down. Our entire exposure, we have marked it down by 50%, and we think we are fully covered as far as this, security which we hold is almost same as the value of, which we have marked it down to. So I don't see any further need for any loss to be taken on this, and we should be able to realize whatever asset we have marked down the value to.
Sure. The next one, Shobhit, is on low duration fund. What we can expect in terms of return in low duration over next 6 to 12 months time horizon?
So again, I think low duration is also somewhere close to maybe 5% on the portfolio yield. I think month end, what number we have been showing here is 491. So yeah, so between portfolio yield is just under 5%. I think expecting 4 to 4.5 would be a number which could be indicated, because of around 5 or 475 to 5 is perhaps the range on the portfolio minus expenses. I think would give you around 4 to 4.5 as the return which one could look at in these kind of products.
Sure. Next one, Shobhit, is how do you see rates at short end of the yield curve? So can low duration and short term fund be recommended in the retail segment against the short term FDs?
I think so. I think short end will remain well protected. Liquidity, as long as it is going to remain good, there's no need for short end yields to rise. In case inflation comes down, as RBI is expecting, and RBI gets room for a rate cut, which can happen either in early next year, maybe by Feb, then I think short-term bond funds can all give very decent returns. So right now, market is not pricing in a possibility of a rate cut. But if inflation comes down, the repo rate goes from 4 to 3.5, then there is a possibility of return being quite good in the short to medium category, all these funds. So I think a lot would depend on how the inflation trajectory plays out, and as inflation comes down and all the vegetable prices get corrected, supply of food items improves, all this happens by November, December end, and then the data shows up by Jan, then there will be some space for RBI to consider a rate cut. And if that happens, the short to medium category will see a very good returns.
Sure. The next one, Shobhit, is again on the interest rates. So somebody has asked, what's your view on the interest rates, and can one look at duration funds at this point of time?
So as we said, view on inflation is basically view on rates is broadly of a where the bias will be of softening, where it will be range bound, but bias is on the softening side. So long duration products we are still not recommending. What we are saying is, because yields on the 10-year has already come down quite a lot, and we are today say at 590 or thereabouts, and the room for it to go down to is maybe till only 575. It is better on risk adjusted basis to not go for long duration products, and look at short to medium category. Long duration, we will have far more conviction if 10-year bond yield for any reason crosses 6% and goes to 6/4. I think if 10-year crosses 6/4, that will be the time to look at adding long duration, whether it is GSEC or medium and long duration or gilt fund. Those are the products which one can consider. But I would be much more comfortable recommending those if the 10-year were to spike to 6.10 or 6/4.
Right. Next one, Shobhit, is what's your view on the dynamic bond category, and should one be looking at that?
Personally, I'm not too favorably inclined towards dynamic category. Somehow the category hasn't played out to its potential. Typically, when rates are when rates go down, you're supposed to be very long. When rates are going to go higher, you're supposed to be short. In practice, to achieve both these correctly all the time becomes difficult to achieve. So we have not been that favorably inclined towards this category. I think the same objectives can be achieved by doing a mix of, say, gilt or short-term, medium-term debts and those kind of products. So I don't see any great value which comes from this category.
Sure. So thanks, Shobhit. So I think we are through with all the questions that had come in today. So that's I think we will end the call here. So thank you all, the participants, for your time and patient listening. Thanks, Shobhit, for your time. So we are sure this call would have added great value and will help you in sharing views with your clients. So friends, thank you once again for logging in. Be safe, take care, and have a nice day. Bye. Bye, Shobhit.
Bye.